Let's welcome on board Laurence Balanco, technical analyst at CLSA. He's joining us from Sydney right now to talk about what he's making of the world markets. Laurence, hi, morning. Great to have you on the show. And, Australia, you've got DAX, you've got CAC, the S&P, all of them making record highs. What's the screen telling you?
Yeah, I mean, we've really seen rest of world outperform US being the key performance since the April low. So despite the S&P having a meaningful rebound, it really has been the rest of world indices from the ASX 200 to the DAX, as you mentioned, actually outperforming the US. And you can throw the breakdown in the US dollar as an additional factor generating this relative outperformance. And we still see positive price action in the Nifty. You know, the Nifty itself has completed this double bottom pattern that we think trades back to 26,300. So, new highs for the Nifty is what we're looking for.
Hi, Laurence. Morning. This is Shrishti also joining in. But back home on the Indian markets, Laurence, we believe that you have been bullish since the month of April after that double bottom formation. But now that the markets are above that 25,000 mark as well, give us some sense. Where do you see the markets headed from here on? Because the RBI push or the rate cut push indeed on the fundamental side give the booster to the markets as well. But at this price point, do you believe that the market should halt or they can continue the run up from these levels?
In the short term, we can see a bit more of a consolidation, but it doesn't take away that the double bottom pattern still gives you this upside target of just over 26,300. So new highs for the Nifty. But I think particularly in the US market, and you can see it in the local Indian market, some of the rotation into lagging spaces. So, last week we highlighted the small cap index, which has started to accelerate higher and sort of play catch up after underperforming since peaking in December. So we've got a few of these sort of catch up trades starting to develop, and that should increase the participation and breadth for this advance that we've seen in the Nifty.
Laurence, morning. This is Snehi also joining in on the show. Last time we interacted with you, we spoke at length about the dollar index. Now that has been quite steady under that 100 mark and has been range bound ever since. What are you making of emerging markets amid a global situation like this, where you also have the tariff overhang, you have talks between US and China, we're understanding US and Mexico may be reaching a deal. Where do you believe that emerging markets, and especially India, stand amid the global backdrop?
Yes, I think just going back to that dollar index commentary, the break of 100 we think is meaningful. Not only does it end the trading range that you had from 2022, but we think it does mark the peak to the dollar bull market that you've had from the 2011 lows. So we think a major trend reversal is playing out. The breakdown from that 2022 to 2025 trading range with the break below 100 gets the dollar index down to the 89 to 90 area. So we think at least another 9% downside in the dollar. And historically, what we've seen, a weaker dollar has been positive for the broadly emerging market index. And if you look at the EM versus DM ratio, that bottomed in December. We haven't made any new relative lows, and it does look like we're retracing against a trend of underperformance that we've seen over the past 15 years. So we really think we're just at the beginning of a re-rating in the emerging market basket. And India, while it hasn't been top performer year to date, we still think it is going to be one of the top performing or better performing emerging markets, and our longer term upside target for the Nifty still sits at over 37,000. So trend is there, and we think continues to improve.
That's, of course, 2030, Laurence. But within the year, where do you see the Nifty range? Because it clearly seems like it's just a matter of time that Nifty also will try and play catch up with its global peers, which are already hitting fresh highs.
Sure. I mean, so we wouldn't be surprised through the summer months that we get above the 26,300, then potentially see another consolidation period, and then obviously we think stair step towards that 37,000 area. But yeah, the first target we're focusing on is at 26,300 through the summer.
You say that. But Laurence, what do you think the texture of the Nifty is going to be? And I'll come back to the debate on large caps versus what's happening in SMIDs, but purely within the Nifty, because what we've seen since start of the week is that there is a great sectoral churn which is at play. The underperformers are the ones which are pushing up. So it's not just financials, but IT, which was the most unloved sector, FMCG, they are the ones which are actually propping up. Do you sense that the rally in India is going to get more broader with days to come and the underperformers will participate now?
Look, I think you've seen a rotation into the laggards right now. You've seen it in the US where the stocks that have performed the worst over the past 12 months have outperformed the best performing stocks over the past 12 months. And that's only happened in the month of June. And you've seen it in the local market. We're starting to see it in a bit of China too. So this is a bit of a rotation theme that you're seeing globally. I would take a step back and look at, we don't think there's a change in leadership, that the leadership within the Indian market will remain centered around the financials. And your underperforming spaces in IT, pharma, and FMCG is likely to continue. So outside of the short-term rebound and rotation into laggards, we think the structural uptrend from financials is well intact. And, into that 37,000 target that we have, financials will be a key leader in that.
But other than financials, Laurence, which sector do you believe can participate in this sector rotation?
Yeah, so probably the most recent one that looks very enticing here still is the real estate space. So, it's not just DLF that we've seen lead, but we've started to see some of the laggards within that come through. So I definitely highlight real estate as a leadership sector coming through. And then more broadly, the PSU. So, not just PSU banks, but we're starting to see other PSUs also participate and recover, having peaked in July last year. So having been the first sort of major sector to have peaked last year, that started to base out and break through that downtrend resistance. So we'd also put the PSUs as now participating and driving some leadership.
That's what you're liking. But Laurence, where are you placing the entire consumption theme in your pecking order of the themes that you're liking? Because on one hand, you've seen the front loading happen by the central bank. On the other hand, we're predicted to have a very healthy monsoon this time. The macros are looking favorable for consumption. But still, some of these pure play FMCG names, they're still not seeing a run up in demand or their individual earnings in the quarter gone by. Where are you placing your bets amid the consumption theme? What are some subsectors you're liking? And what's your overall view on the sector?
Yeah, so again, if I look at the longer term trend of FMCGs, we think they continue to underperform. There are one or two stock specific ideas that, can outperform and give you some leadership. But as a broad sector observation, we think that space remains an underperforming space. Autos probably has a better chance than FMCG to start to recover. We've actually started to see some of the laggards like Bajaj Auto and Hero Motors start to recover, having had meaningful underperformance. And then you've got the leadership within that group like TVSL, as well as Mahindra starting to break out of consolidation patterns again. So we think autos ahead of FMCG at the end of the day. And then we have to take into consideration, the platform internet type names like Eternal having consolidated below its 200-day for the past 5 months. We've seen a break above that 200-day, and that does suggest that it retests the high. So more stock specific names within the consumer side, but autos over FMCG, if I had to just highlight the two sort of key sectors within the space.
What's the take on the sensex IT? Because that's been making some, attempts, more so the mid-caps within the IT pack. But do you think it looks like a sustainable move, or it's too globally linked and this is just a short-term or intermittent move that one is seeing?
Yeah, broadly, I would say because of the large cap weightings within that RT space, it does look like it's an intermittent move rather than something more structural or more significant as far as a re-rating goes. And yes, I think, again, focus on mid and smalls within that RT space, but the general trend in IT is outside of a rebound rally, one of underperformance.
And I also want to come back to, real estate, because real estate from those COVID lows has had many years and many long elongated bouts of a meaningful rally. And then again, there was that pause ever since April that played out in the realty pack. And now once again, they're beginning to show up. Do you believe that too it's going to be a more broad-based move? Or again, do you think it's going to be very selective within the larger names that the realty rally would restrict itself to?
Well, definitely, there's more evidence of broadening of participation there and something more sustainable. So, outside of financials, the real estate side does look significant, and maybe put that into the context of the NSE infrastructure sector as another sort of leadership group that is re-emerging with the PSU, the broader PSU space, but definitely a broader participation within real estate, within the infrastructure space, and then also adding that into the PSU basket of leadership.
Same thing is going to happen within financials as well. The rally is not going to be restricted only to an ICICI Bank, HDFC Bank and a Bajaj Finance, and will be a more bottom-up story now?
Well, yeah, I think some of the non-bank financials look quite compelling. Something like Shriram Financial, Chola, recovered off the April lows, has hesitated below the 2024 highs over the past 3 months, and they both look primed that they can break out from here. And those would be meaningful breakouts that you can get upside targets of 40% above the highs that you made in 2024. So yeah, the non-financial space again looks attractive, but the broader financials is really where we see the core leadership of driving the market up to 37,000, including the non-financial, non-bank financials.
Laurence, from April lows, we have already seen a double-digit return for Nifty 50, while the financials have been participating in a big way. But given the fact that you are still positive on the small and the mid end of the market, do you believe that the leadership now, or rather better returns one can expect, could come from the small and mid cap? Because back in the month of March and April, when there was a fear in the market, the consensus call was to stick with the large caps. Now that we have seen a great move over there, do you believe that the portfolio churning, or rather the shift, can be tilted more towards this mids?
Look, I think for me, that is the catch-up trade that is developing. Is it a major breakout like we had back in early 2023, where both the mid and the small cap indices broke out of 2-year consolidation patterns? It's not the same structure that gave you that 18-month period of significant outperformance from mid and small caps. So I think this is sort of more broadening of participation, where both the mid and small caps can outperform, but not to the same extent that it did through 23 and 24.
Laurence, appreciate that view, but also want to get your sense on some of these precious metals moves that we're seeing. Now that we're seeing some stability on the fundamental front between US and China talks, you have gold that's taking a little bit of a softening. It's seeing some softening rather. And on the other side, you have silver that has done very well recently. If you had to weigh both of these precious metals, where would your bias lie? Would it still continue to favor gold even after the run-up that we've already seen here?
Yes, it's quite interesting. I mean, again, it's this laggard trade, right? So if you look at silver, you look at platinum, you look at palladium, they were all the big breakouts last week, Friday, similar to the underperforming stocks over the past 12 months starting to break out. And basically, if you look at the gold-silver ratio, silver's underperformed significantly versus gold over the past 12 months. This breakout that we saw in silver last week gives you an upside target of $42. So I think the trade here in the near term is to be a buyer of silver over gold, looking for $42 on the upside. The setup on gold, though, isn't bearish. It's just a consolidation pattern of the impressive gains that you saw into the April highs. And the consolidation pattern that you've seen on gold, we think ultimately sets the platform for a resumption of gold's longer-term uptrend that will then look to targets of 4,100. So, tactically, silver is clearly the play here for $42 upside target. And the gold consolidation, while we probably still have a bit more volatility in the range, will ultimately point to 4,100 as the next upside target there. So longer-term trend in precious metals, including the platinum and palladium, the PGMs, is bullish. And you can accumulate gold here, but the momentum trade is to be buying silver.
But if someone had to put fresh money to work, Laurence, just for, say, the next 1 to 2 years, what should they pick out? Would it be platinum, gold, silver?
But actually, if you're looking at it on a 2-year basis, I think the biggest upside in the PGMs is palladium. That's trading around 1100, and you basically get a 2000 upside target. So if you're looking within that precious metals PGM space, I think palladium's the interesting one with 2000 on the upside. If you're more conservative, want that lower beta volume option, gold is still, I think, worth buying at this level. But if you want the high beta play, look at palladium.
All right, so that's the call coming in on the precious metals. But along with that, let me come back to the Indian markets, Laurence. We have touched upon a lot of sectors, but if I ask you to pick the top 3 sectors that can be the outperformance and the top 3 which can be the laggards, if you can help us with the ranking over there.
Yeah, I'm going to be like a stuck record, but financials to me is still the top performing sector. I would backfill that with real estate and the broader PSUs. Or if you don't want PSUs, you can look at infrastructure. So those will be the 3-4 sectors that I'd focus on the upside. And I'd still look for pharma, FMCG and IT to be the laggards.
Always great chatting with you, and we covered a lot of ground. Good speaking with you. Thank you for your time.
Thank you.
Okay, with eyes set on that 37,000 target for 2030 and this year as well, a fair